Hey everyone, this is Robert Keens with goldsilverpros.com. It is Sunday, December 6, 2020. And for the topic of today's video, I'm going to talk about how the CFTC, which is the regulatory agency for the futures commodities markets here in the United States, has completely failed in its role. We're going to go over the history of how it's failed in its role and what the challenges were. Not all the challenges were directly related to the CFTC itself. It actually tried to do the right thing almost about 10 years ago after the financial crisis, but it was thwarted by several entities. And then we're going to go on to look at some research which shows that manipulation or speculative positions, financialization of the futures market affects prices and increases volatility. There's a lot of research out there on that. Let's go ahead and get started, and we go right into it today. Title of the presentation is CFTC Position Limits, a study on the failure of regulation in the commodities futures markets. We're going to start off talking about the origination of limits. It started with Dodd-Frank. As many of you know, Dodd-Frank came about as a result of the financial crisis, 2008, 2009. It was the big legislation put into place to regulate the financial markets to hopefully prevent some of the things that led up to the mortgage meltdown. It is officially called the Dodd-Frank Wall Street Reform and Consumer Protection Act. And here's a quote from a Wall Street Journal article, which you can see down here at the bottom in blue. You can go to that article if you wish. A quote from the Wall Street Journal from October 15th article was, the Dodd-Frank Act passed after the 2008-2009 financial crisis included a provision requiring the CFTC to set position limits in response to lawmakers' belief that speculators had caused a sharp increase in oil prices. Moving on to some of the Dodd-Frank requirements, there was a study done from a law firm, DLA Piper. It's a global law firm with lawyers located in more than 40 countries throughout Americas, Europe, the Middle East, Africa, and Asia Pacific. They did this really nice white paper. It was written by Deanna Reitman and Sarah Neighbors on the history of Dodd-Frank as it related to the CFTC. Highly encourage you guys to go read it. The link is here in blue if you want to do that. It said Dodd-Frank required the CFTC to establish federal speculative position limits for futures and options contracts traded both previously and the exempt commodities, including energy and metals products, and agricultural commodities, which would include the agricultural products for which the CFTC has historically set position limits, as well as an expanded range of agricultural and soft commodities. So a few things here. The CFTC was created to regulate the markets, and by and large, it did set position limits for a lot of agricultural products on the exchange. It did not for energy, it did not for metals, and there were some other agricultural and soft commodities that did not. So the original position limit setting that CFTC had done had been only for some agricultural ones. The Dodd-Frank required it to expand those powers, and it was very explicit in its requirements there. In the Dodd-Frank legislation. So that is Congress authorizing CFTC to expand setting position limits for purposes of futures trades. What is a position limit? A position limit is the size in which an entity on the futures exchange can take within a given commodities market or on the exchange. It limits their overall impact on the exchange, so you don't get one player or two or three players in there with too much power on the exchange with the ability to set and manipulate or change the direction of prices in some other way. Position limit enforcement failure. So there's a history there of not being able to enforce position limits. We're going to get into the entire history here and give you quite a bit of detail here so that you know where we stand today and where it has come in the last 9 years. Position limits were never enforced as a result of Dodd-Frank. Originally in 2012, they were challenged in courts, and we're going to tell you who they were challenged by, and it's not going to be any surprise when I tell you. Per the same Wall Street Journal article we quoted earlier, in the presentation, I've got another quote here for you that I've highlighted, and the emphasis is mine where this is bolded. In fact, all the places where it's emphasized on a quote in the presentation is my emphasis, and I do that to bring out certain things within the documentation I'm showing you. So the Wall Street Journal article says, but the issue proved remarkably thorny as it affects a swath of market participants, including farmers and ranchers, hedge funds, futures exchanges, energy producers, and banks. 4 previous formal attempts by the CFTC to establish position limits failed amid opposition from industry, including one final rule that was thrown out in federal court in 2012. So this is the article written in October 15, 2020, and I'll tell you why that article was written here in a moment. But now we're going to backtrack and go back to 2011, 2012 and show you the history of CFTC trying to impose position limits on these additional exchanges or products on the exchange, metal, energy, and some of the additional agricultural ones, and where it failed. And we're going to go into that detail. So in 2011, CFTC issued its proposed rules. It was to establish position limits for specific physical commodity derivatives. They were setting limits and also creating limit formulas, ways in which to calculate what the limit should be and move around as the exchange grew and changed and the different positions changed. It included both futures and options, and it established aggregate position limits across different trading venues of the same commodity, meaning for the whole year and not only on an individual exchange, but across the exchanges. Very interesting plan that they were putting into place, really to regulate the overall size of a position anyone could have on any of the exchange, the futures exchanges or options exchanges. It included an exemption for bona fide hedging transactions. A hedge is when basically in its basic form is a legitimate producer, say you're growing wheat, takes a hedging position short in the price of wheat so that in case the price falls between the time that he plants the wheat to the times it brings it to the market, it ensures his position on the market for what he anticipates or wants to get for his wheat. And those estimations of what we will sell at, as well as all the other commodities some point in the future, is built into how much they're going to plant or how much they're going to produce and how much they're going to spend on it. So they need to know within a relatively small range what that price is going to be. So legitimate hedging is using the futures markets to protect from those types of things for legitimate producers of an item. Hedges can also be used for manufacturers who may be using the end product. Say someone's going to buy silver to put into a solar panel, and in case the price of silver rises, they're going to want to take a long position to hedge that price risk so that they can keep their price exposure small if they know they're going to be using a lot of silver. The same goes for the other commodities as well. That's legitimate hedging. Okay, so the CFTC proposed limiting 1/4 of the deliverable supply for a commodity in the spot month, meaning you could not take a futures position over 25% of the total deliverable supply in that month for any given person making that position on the exchange. So it would limit the speculative position power that you had. You couldn't take a speculative position of 10 times the amount of deliverable commodity that month. It was 1/4 of the deliverable supply per each entity. It also included an all-month limit. That's an aggregate limit for all futures positions in a specific commodity. So again, a lot of really good proposed rules. So the CFTC, after the Dodd-Frank Act was passed, tried to actually put some good rules into place. It wasn't their, as you see, it's not going to be their fault that these didn't actually get ratified and put into production, as they say, on the actual exchanges, because they did propose some really good rules here. A district court intervened. And I'll tell you why they intervened here in a moment, but I'm going to read some quotes from the Reitman Neighbors white paper that they wrote. With the final rules due to take effect on October 12, 2012, the ones I just quoted you, on December 2nd, 2011, the International Swaps and Derivatives Association, the ISDA, and the Securities Industry and Financial Markets Association, the SIFMA or SIFMA, filed a challenge to the position limit rules in the U.S. District Court for the District of Columbia. On September 28, 2012, the court vacated the final rules, remanding them to the CFTC. What that essentially means is it got challenged, CFTC lost, the court sent it back to the CFTC and said, you have to do some additional work before we'll accept these as being enforceable, meaning the CFTC lost. So let's go back to the beginning. CFTC was created by the Commodities Exchange Act. I think it was 1974, 1975 timeframe to regulate the markets. The CFTC regulated using position limits, among other things, other rules that it has in its power, mostly agricultural commodities in terms of position limits, but not energy and metals and not some of the agriculture and other soft products. There was a hue and cry in 2008, 2009 for the prices of a lot of commodities on the exchanges really spiking. Of course, that was corresponding with the problems we're having in the mortgage market. Dodd-Frank was passed to deal with a lot of the problems we have in the financial sector. It included additional rules for CFTC to set position limits because of what they saw, what Congress feared they had seen in the futures markets and in the speculative end of the commodities markets. So law was passed by Congress. Now a district court says you can't actually do that. A court basically, I think, is legislating from the bench and trying to interpret what Dodd-Frank meant the CFTC to have power to do. Even though they had power to do it before Dodd-Frank, Dodd-Frank reaffirmed and expanded their power. The court says no. Let's talk about who was challenging that. It really is interesting who is challenging the CFTC's powers here. The ISDA is a trade association whose membership represents participants in the privately negotiated derivatives industry. Aha, the other side of who would be regulated, the derivatives industry. Also, SIFMA is an association of hundreds of securities firms, banks, and asset managers. So in other words, the people that would have been regulated by the new rules promulgated by CFTC through the powers given to them by Congress through Dodd-Frank basically went to court and got it overturned. No surprises there whatsoever, but wait until you see what the court said and how sketchy this kind of was. I think it's sketchy in my opinion. The CFTC rules vacated. Here's the details. The two challengers challenged whether Dodd-Frank mandated that the CFTC actually create position limits and whether sufficient studies on harm are required, whether they had to show that there was harm before they could set those position limits. They were challenging this because some of the legislation didn't pinpoint all of the exact rules. It kind of left it open to interpretation for the CFTC. But the challengers were saying, well, we don't think they have the ability to do this. And they were just challenging everything, trying to see what the court basically would give them. The court then opined that the Commodities Exchange Act, which created the CFTC back in 1974-75, had given these authorities before Dodd-Frank. So the court was saying, well, they've had these authorities before, and then Dodd-Frank basically reaffirmed and expanded them. But there were questions still to be settled by the court. The questions centered on whether the CFTC had to provide sufficient proof that speculation affected prices and harmed commodities markets, and therefore placed an undue burden on the economy. So it wasn't just the fact that the CFTC had the right to set limits. The CFTC had to prove that if it didn't, it would have an adverse effect on the economy. I don't think that's what Dodd-Frank intended, but that's what the court said. While the legislation required CFTC to set position limits, it was unclear whether position limits were justified, especially the aggregate ones. You look at the all months and across all the different exchanges, those are the ones that were really being challenged. The court vacated the rule in favor of keeping the status quo to minimize disruptions to the economy. In other words, what the court had to interpret was not only the Dodd-Frank legislation and the rules that CFTC had passed, but whether those rules themselves would have an adverse effect on the economy. In other words, the court essentially sided with the commercial sector and the speculative position limits because it didn't want to screw up the economy. That's essentially what it was. That for me is legislating from the bench because it wasn't the spirit and the intent of Dodd-Frank nor the rules that CFTC created, but nonetheless, that's what the court said. So they sent it back to the CFTC for further analysis. The CFTC did do further analysis. Again, another point towards the CFTC. They proposed rules as authorized by the CEA and then the Dodd-Frank. They got rejected. So then they went back and they were going to do further analysis and revamp the rules. Again, CFTC is doing their job here. So give credit to CFTC. Round two, 2013. 2013, the CFTC tried rules again. This time, and this is key, the next 4 bullet points are key. They provided a more robust historical account of 1, market manipulation events, 2, large historical market swings, 3, historical large trader reports, and 4, they challenged studies claiming a lack of harm through excessive speculative activities using the data they had. Now, this is the regulatory agency that has all the data supposedly, and we'll see later where there's some issues there, but has all the data or more data than anybody else, certainly whatever's published online for that we look at all the time. They have insider data, supposedly. They did a study on large historical market swings, historical large trader reports. They have all of this information. And they say, based on this, this is what gives us the reason to set these position limits. Again, go back to the court, where the court said, you know, can you prove that you've harmed the commodities market? So the CFTC does this. They answer the court's question in their 2013 proposed rules. They also provided definitions for a host of trading terms to clear up ambiguities in terms using Dodd-Frank. When Dodd-Frank was written, it was written by legislators who didn't have all the terminology down of the specific markets, okay? They basically got it right, but some of the terminology was a little murky. So CFTC provided expanded definitions for everything to clear things up, just to make everything clear so there wouldn't be any more ambiguities if it got challenged again and put back in court. They anticipated to address those concerns that had previously challenged 2012. So again, CFTC is doing a good job here. So congratulations to them for doing a good job. They also further define the aggregate position limit rules and definitions, and they further define bona fide hedging. Remember, bona fide hedging is when you have a producer or you have a manufacturer who's going to produce or use that product that's being traded, and they have a more direct effect on their operations. They're considered bona fide hedges, versus just speculative positions of people playing the market, basically gambling on the price or playing the market on the price. So the CFTC does a lot here. They do a lot here to make it more clear in their proposed rules. One of the things that I didn't like what the CFTC did is then they put those rules out for people to make comment. And it took 3 years before they absorbed those comments and made more changes, all the while not enforcing the position limits. Okay, that's a little bit, that's not an ideal situation for the CFTC. I don't think they should have taken that long. They gave 3 years for people basically to answer this while they weren't enforcing them, and continuing to let that market basically run without a lot of regulation that they need, that was authorized by Dodd-Frank. It will be 5 years now by the time the CFTC revisits their proposed rules from 2013 in 2016. So then the CFTC took those comments from their 2013 rules from the industry and third-party commenters, did a third proposal in 2016. They refined rules on speculative position limits based upon comments received then. They set rules for 25 previously exempt commodities. Okay, they're getting more specific here. They delayed compliance with the rules, though, until January 3rd, 2018 for 2 reasons. They needed an adequate system to calculate the limit value. So they needed a system, a tool to help them get the math right. And they had to give time for traders to come into compliance, which kind of makes sense. You got to give a little bit of time for traders to unwind their positions and not get slammed, although, you know, morally, I don't think that they were required to do that because the traders are basically manipulating the markets, but I understand why they did it. Specifically for metals commodities, they relied on limits proposed by CME Group. And this is really interesting. Listen to what CME Group says here, which were lower than the 25% threshold the CFTC recommended previously. So remember back when the CFTC set their original thresholds, 25% of that commodity trading in a month, an individual entity, like a swap dealer, financial hedge, whatever the case may be, cannot trade a speculative position over 25% of that month's deliverable commodity, okay? The CME Group, which basically oversees all the exchanges, actually said, no, it should be less. So the CME Group had reason to believe that 25% was too lax. So what was the CME Group's data saying there? That didn't actually come out in the report, but they're saying, no, actually lower that threshold. They also recommended less than 25% for these energy trades as well, heating oil, natural gas, and gasoline. We're going to come back to why that's important, why the energy trades are so important later on, because it has to do with food and its effect on food. And we'll get into much more detail when we get into the market studies later on in this presentation. But these two things, the metal commodities and the energy, pay particular attention to. There's going to be reasons why these are particularly important later on in the presentation. The CFTC in the third proposal also made new rules for bona fide hedging, which were confusing, however. By the time the CFTC got to their third rule set, the rules were 280 pages long, which is a lot, with 1,700 footnotes. It's too confusing for people to implement. Nobody was able to implement this. It was so complex, the CFTC didn't have the people, the resources, the tools needed to implement this. So for the next 3 years, basically position limits also were not enforced. So again, it's now going to be 8 years. We're going to see in 2019, there was another event which occurred in which it had been 8 years since Dodd-Frank, and we're still not enforcing position limits that Congress wanted CFTC to enforce. And that's why they put it into law. So we had a position limit rules quagmire. And at the time of the paper that the law firm wrote, which I've been quoting all the way through here by Deanna Reitman and Sarah Neighbors, they wrote this in 2019. So the current commissioner now that we have in 2020 is actually different than 2019. 2019, it was Commissioner Quintens, who was ending his term. And he was a Trump appointee, by the way, just for anybody that cares. The current commissioner calls for simplifying the rules in 2019. This is extremely important because I believe this commissioner was basically a mouthpiece for commercial interests, and we're going to see why. This is a direct quote from Reitman and Neighbors' white paper. Commissioner Quintens argues that the CFTC must revisit the 2016 proposed rules yet again and simplify. This leads market participants to ask whether there is another proposed rulemaking on the horizon. Guess what? There will be in 2020. We'll get to that in a moment. So that was very prescient by the law firm to say that. The commissioner does not want to impair price discovery and liquidity in the market because it creates price volatility risk. Now, the studies I'm going to show you later are exact opposite. The speculative position has caused a price volatility risk, according to the data and in these studies. But the commissioner is taking the side, the commercial, saying, we really don't want to do this because it would impair price discovery and liquidity. Translation, it could screw the commercial positions if we actually set these position limits right now, because they're the ones that have the biggest positions. And we've gone over the COT data many times, especially in the precious metals. And it's the commercials that have the largest concentrated positions. It's not anybody else. I mean, all the other entities have concentrated positions, but it's the commercials that are really, really concentrated. This is an excuse. And I think, again, one of the reasons why I think this commissioner, Quintens, was a mouthpiece for the commercials. And you'll see there's more. Does not want to dictate to commercial firms how they manage their risk. Well, wait a minute. The whole purpose of the CFTC is to regulate the exchanges and to dictate to commercial firms and everybody else how to manage their risk. Not how to manage their risk, but really their positions. Then it's up to the commercial firms within those rules to manage their own damn risk. Okay, so the CFTC wasn't trying to manage the risk, it was trying to manage the market. And then the players that are in it have to manage their own risk given the rules. So basically the commissioner is legislating from his position. He's an appointee of the president. He's not even elected. He's, it's not like his position is elected and authorized by Congress. He's an appointee, okay? And he's basically legislating from his position, just like the court did in 2012, and they vacated the CFTC's original position limits. And this is ridiculous. This is not what Congress has authorized this. And it's silly, but this is the position that the commissioner took. He wanted a simple method that could be applied efficiently. Well, don't we all, except for the fact that these markets have gotten so complex and financialized. When they become financialized, they become complex. You can't put simple rules on them. So he's asking them basically to do the impossible. But you'll see the impact of what he asked for on the next slide when we talk about what the new rules are and how ineffective they're going to be. When he say simple method, that basically is translation for taking away their powers to effectively regulate the markets. We'll show that in the next slide. Also, he made this absurd comment that risk definition should be expanded beyond price to encompass operational, liquidity, credit, political, and seasonal. Okay, operational translates to the traders on the exchange because the CFTC doesn't really have a lot of operational risk other than the fact, do they have enough resources to do what they're authorized to do? The operational risk is the actual traders. Well, it's not the problem of the CFTC to worry about their operational risk. As I just said, that's the responsibility of the individual people trading the market, the firms and the large entities, not the CFTC. So this is, again, a silly, ridiculous thing that risk for the CFTC should be expanded to the participants' risk. The CFTC doesn't have to worry about that. That's not their problem. That's not why they were formed by the CEA, and that's not what Dodd-Frank said. And this is a ridiculous requirement. Also, liquidity. The CFTC doesn't have to worry about liquidity in terms of the actual trading. All the CFTC has to do is make sure that there are margin requirements for each contract presented. In terms of liquidity, that's determined by the free market. It's not the CFTC's job as regulator to ensure liquidity. It's a ridiculous statement. That is in favor of the people trading the market, and especially the largest concentrated positions, which would happen to be the commercial firms. So the credit, political, and seasonal. So now he's bringing politics into it. And I think political has to do with the fact that a lot of the commodities markets in the US that trade, like the COMEX, for example, determine prices that are used, if not only in the US, but around the world. They have a really big effect on price around the world. We've shown that the gold price and silver price are determined on COMEX for the entire world. Now, there are other markets, but those are so opaque. They don't determine the trading price. It's COMEX that does. And so what we're basically saying here is that the US COMEX market needs to dominate commodities markets and set price across the world. That's what he means by political, I think. I'm interpreting. But what else could he mean by political? Political has to do with different nation states and their different markets. So that's not the CFTC's remit. And again, I think the commissioner has injected something into this that has nothing to do with the reason why the CFTC was created by the CEA and has nothing to do with the spirit of Dodd-Frank, as I've been reading about in the various white papers and the opinions on it. So I think the commissioner went way outside his remit and seemed to be the mouthpiece for the commercials and actually preventing the CFTC from being able to do what they're authorized to do by Congress, by two different acts, Dodd-Frank Act and the CEA. Also, this is another ridiculous point, the last bullet point here. It expanded bona fide hedging rules to include presumed legitimate until proven otherwise. In other words, the CFTC has the burden of proof to show that it wasn't a bona fide hedge. It's not the entities registering with the market saying we're bona fide hedgers and this position is bona fide hedge. It's that the CFTC has to prove it on the back end. Oh, you made a trade. Oh, that wasn't a bona fide hedge. That's ridiculous. It should be on individual traders to comply with the rules, not the CFTC to have to prove that a rule was broken. It's a ridiculous requirement. And again, it works in favor of the large commercial firms. Obviously, this commissioner basically might as well have been paid off by the commercial firms because he's doing everything in favor of the commercial firms and not in line with the legislation that provided the CFTC the powers that they should have in the first place. Okay. Now, from here on out, these are not quotes from the white paper I quoted from the law firm. This is just my opinion. I think the Position limit enforcement was neutered. The previous CFTC Commissioner Quintens put a nail in the coffin of position limits as a tool, in my opinion. The entire process would need a redo, causing questions as to how it would stand up to another legal challenge, based upon his comments. It seems to have ignored the data promulgated by the CFTC showing that price volatility increased with excessive futures and options trading, which I'm going to show you here in a moment. There is a ton of studies published on the CFT website, in addition to a study I published many times before outside the CFTC, which basically says excessive futures and options trading increases price volatility and affects the market. But I'll get into that here in a moment. They created a new risk definition, which indicated that the commissioner Quintens knew that applying the rules would crash the commodities market exchanges and adversely affect the commercial participants financially, maybe even bankrupting them. He knew that, and he took the side of the commercials, in my opinion. And I think it's blatantly obvious based upon his comments. And I covered that on the last slide. And it seems to push enforcement out of the immediate future. Or if you're going to have enforcement, it's going to be weak, watered down enforcement that's really not going to enforce the spirit of the law, both the CEA and Dodd-Frank. 2020 developments. One of the reasons I'm doing this presentation now is because about a month and a half ago on October 15th, 2020, CFTC had a meeting to finalize position limit rules. You can see that here at the link in blue. And I think the changes are very alarming. And they basically went along with what a lot of what Quintens's guidance was in 2019. And it's basically neutered down CFTC's ability to apply position limits to who and to what commodity. And it also expands bona fide hedges substantially and applies terminology economically equivalent swaps. That's code for it means hedges can include a host of other potential financial derivatives trades on other markets. So in other words, it completely neuters what a bona fide hedge is. Bona fide hedges should be that market, that commodity, a physical commodity either going to be used or produced by a producer or a merchant. That's a legitimate hedge. Now they're expanding it to say, well, it could be positions on other exchanges and other derivatives. It's not what a hedge is. They basically have destroyed, or they basically have put speculative position over the word hedge, but they're calling it hedge so it appears like it's legitimate, but it's not. It's not legitimate hedges. Okay, what did it also do? Non-spot month limits were not applied to 16 new commodities not previously regulated, including the metals and energy, including the precious metals and certain energies. Remember, the CFTC, as a result of the CEA, were enforcing position limits mostly in agricultural commodities. A lot of these other ones that were going to get regulated are not regulated in terms of non-spot month limits, meaning you essentially what they can do is they can go to a forward month, and this is something I talked about in gold and silver all the time. They can go to a forward month, put this outsized derivative position, especially a short position on the market, and it's not governed by these position limits on the current spot month. So how many times have I shown you guys the December deliveries are being made at a cheaper price because of the futures trades now in gold in March and silver. I'm sorry, gold in February and silver in March. I've explained that over and over again. In fact, I'm going to show you that, guys, on a screen share. Give me just a moment, and I will bring up the futures and we'll show you how that works. Okay, as we look at the silver volume, December is the current delivery month. There were 57 deliveries as of Friday, December 4th, but look at the month that's determining price. All the open interest is in March. So in the metals, according to the new rules promulgated on October 15th, or actually aren't in place and won't be in place till 2021, but when they come into place, it would allow someone to short the hell out of the market in a March month and take delivery in December because the non-position limits don't apply to future months. Aha, same thing in gold. Let's look at gold. Let's go back up to gold here. If we can get my presentation software to cooperate. Gold is the same thing. There are 3,122 deliveries because December is a current delivery month, but aha, in February 21, 396,000 contracts. The new rules passed on October 15th would allow this behavior. That explains why the last couple of months I've been documenting all these positions rolling from September to December and then December to February or March. We have this massive open interest that's shorting the commodity and they're taking delivery in the current month. It also explains why you have shadow contracts where you have more delivery than you have open interest on a given day in a trading month, because they can take a futures position in a futures month and take delivery now at a cheaper price. The new rules that be promulgated October 15th, or they were put in place October 15th, and will take a couple of months to come into effect, are basically going to allow this kind of price manipulation in the futures markets. So that's why they're getting away with it. And that's why we've been noticing that the last few months, guys have been watching my presentations on the commodities markets, is because that's what the commissioner wanted. And that's what the new rules are. It basically allows you to manipulate the market. Okay, going back to the presentation. Sorry, let me get the right screen up. Going back to the 2020 developments, the October 15th rules. I've highlighted here a gold agricultural commodities for a reason. Agricultural commodities, which were already regulated by position limits, will have aggregate and non-spot month rules apply. So it seems as though they've got really tight controls on agricultural commodities only, not necessarily energy and metals. However, as we're going to show you, that will not reduce the price volatility completely in agricultural commodities, because there's a ton of research that shows energy volatility affects agriculture, lots of studies. So don't expect food prices to calm down and to be less volatile. They'll still be volatile because energy, which is not being regulated in non-spot months, has an effect on agricultural commodities. There's a lot of research showing that, which we'll get to here in a moment. One other thing the October 15, 2020 meeting finalized in regard to position limit rules is it extends some changes in margin requirements from September 2021 to September 2022 and certain swap portfolios. So certain swap portfolios that were less liquid gets an extra year, basically gets them an extra year to figure out what to do with the swap portfolios before they have to pay additional margin, before that additional margin goes in. So that gives time for people to exit those. Only significant where if it's a less frequently traded market and you have an outsized position in it, you can adversely affect it more easy with a smaller position. So it allows them more time to get out of those. You know, not as significant as energy, agriculture, and metals, but still of significance, and still works towards the commercial's position. Hampers the CFTC to do their margin requirements on some of those swap portfolios for basically 2 more years. Works in the favor of the commercials trading the market again. All right, moving on. I want to talk about concentration of positions. So the limit, the non-spot limit positions don't apply to the metals. So guess, you know, pulling information from Nick Laird's site, Gold Charts R Us, guess which markets basically have the highest concentration of small amount of traders. And I've showed this chart before. 4 largest traders, 8 largest traders. It's in gold, platinum, silver. The ones that will not be regulated for non-spot position limits. Meaning, again, re-explaining this, these metal positions, which are highly manipulated by short positions, gold, platinum, and silver, are the ones in which the CFTC will have no regulatory authority in future months outside of spot months. Meaning, again, the game I've been showing you for the last 2 months, and I've been trying to figure out why this game has changed, why they keep rolling their massive short positions to a futures month on current month delivery so they can get the metal cheaper. It's because they knew, based on Quinten's comments, they knew that the October 15th rules promoted this year were going to allow them to do that they weren't going to be able to regulate futures months speculative positions that, and in fact, control the price in the current delivery month. And they've been that's why they've been rolling their positions more lately, because they knew that was the rule was going to come down. And so the lack of the non-spot month position limits affects the ability of the CFTC to stop this manipulation, this massive shorting of these gold, platinum, and silver. By the way, I'd also like to point out that there are still massive positions in agricultural commodities. I wonder if these will change as a result of legislation. I have a feeling they won't. They're going to figure some way out of it, but hopefully they will. We'll see. Moving on, there's some market studies on speculation. Now, one market study, the second one here, the second link, the digitalcommerce.law.yale link, is a report, a research study done by Jerry Markham. It was published originally at Yale, and also Florida State, I believe, has it. It's basically around the internet. It's a study on about 140, 150 years, dating back to the late 1800s, of commodities markets and how they're highly manipulated from the time they started till now. And the whole reason why any rule had ever been created was to deal with a previous manipulative practice, including the CEA, which established a CFTC. The reason the CFTC was established was to stop speculative positions and outsized market activity, which it's never been able to do because it's never had the power to. And every time they try to do it, they keep getting thwarted by the courts, or people taking them to court, or commissioners of the CFTC who basically chop the regulatory agency's legs out by making ridiculous positions in favor of the commercial speculators. So, but that study, basically, I've printed it many times on my channel. Go back and watch those videos. So I'm not going to go back into that study. But in addition to that study, which I promoted, I found a ridiculous number of studies actually on the CFTC website. This top link, reference studies collected by the CFTC on their website in 2011, 2012, which is why they wrote their original rules saying the speculative positions create price volatility and price changes that overwhelms the normal long-term market trends, are right here at the CFTC website. You can see it here at this link. I'm going to go into a select few. Now, there are a lot more that I'm not going to document here because it'll take way too long, and this presentation will go for hours. Suffice it to say, there are a lot of studies which show speculative positions affect agricultural commodities, energy commodities, and metals commodities. We're going to go through a few select ones. There's one done by the World Bank Development Prospects Group, and I apologize for getting any names pronounced incorrectly. It's John Baffis and Tassos Heniotis in 2010. They wrote a paper, and I have a couple of key quotes here. The paper concludes that a stronger link between energy and non-energy commodity prices is likely to be the dominant influence on developments in commodity, and especially food markets, agricultural markets. Demand by emerging economies is unlikely to put additional pressure in the price of food commodities. So anyone that tells you on the internet or otherwise that says the whole reason food prices are going up is because of emerging market demand has been debunked by this study by the World Bank. The researchers did not find it. They found a stronger link between energy and non-energy commodity prices. Remember earlier in the presentation when I highlighted the agricultural commodities in gold, and I said, yes, there are position limits on agricultural commodities, but it won't fully reduce price volatility of the speculative positions there. Is because this study found that energy prices, which are not going to be regulated non-spot month position limits, those prices will affect food prices. And that was the strongest determinant. It wasn't the actual supply and demand of the physical commodity in the market in that month itself. So how effective do you think the agricultural position limit rules are going to be when they can't also do the energy ones? And they can't do the energy ones. It means there's still going to be price volatility in foods. So still expect price to continue to go up, especially during a crisis. The CFTC can't regulate that because the back door in is through the energy of prices. Energy is a major input to agriculture, and those prices will affect the prices of energy, especially speculative positions in energy, which raises the price, which will not have the same robust set of position limits on it that the CFTC can enforce by their own rules set October 15th of this year. A second quote, the use of commodities by financial investors, the so-called financialization of commodities, may have been partly responsible for 2007, 2008. So in other words, the financialization or the futures markets themselves and all the speculative positions affected the price spikes of the foodstuffs. And it's right there in the World Bank study. And the last one, and maybe potentially the most important quote out of all this, and I'll tell you why, is their study supports the thesis that price variability overwhelms price trends. In other words, short-term speculative positions overwhelms long-term price trends. In other words, if you can manipulate the market in short term using outside speculative positions, you can manipulate the long-term price trends for that commodity. Ooh, how many people have said the CFTC futures don't affect the price in the short term and especially in the long term? Well, the World Bank begs to differ based on their study. This is big time. And I'm going to show you another study here in a moment, which shows the interlinking between the short term price manipulation and the long term, and gives immense power to people speculating in the market and controlling short-term price movements, because those price movements start to align with the longer term price movements and gives them immense power over commodities prices long term. Immense power. We'll show you that here in a moment. This study, Fundamentals, Trader Activity, and Derivative Pricing, done by the CFTC and the Security Exchange Commission by several authors. A couple of key quotes in there. And this was done in 2008. We document that in the wake of strong growth in the market for exchange-traded crude oil derivatives, the prices of 1 year and 2 year futures became co-integrated with the price of the near-month futures. In other words, if you can manipulate the near-month futures contract, it would start to line up with a 1 to 2 year. You could start to control, in other words, the 1 to 2 year. They would fall in line. So all you had to do was manipulate the near-term contract, and that would affect both the 1 and the 2 year contract as well. That gives immense power to someone who only has to manipulate the near-term contract. That came straight from the CFTC and the SEC researchers in 2008. Bam, straight from the horse's mouth. The people that have the most insight into these markets are saying that in their study. Irrefutable evidence that manipulation of the markets in the short term affects long-term prices. Period. End of story. Second quote, we find that fundamentals contributed to this pricing development. We also find that an increase in commodity swap dealer positions in nearby contract, as well as increases in the market activity of other traders, in particular hedge funds and other financial traders' activities, helps further explain the co-integration of prices and markets. So fundamentals of the market did affect it, but it's the co-integration of the manipulative speculative positions that really affects the market. Powerful, powerful, powerful piece of research. It basically debunks everybody that says, oh, these futures markets don't affect the price short and long term. BS. Their own researchers from the CFTC and the SEC debunked this 12 years ago in 2008. And that study is sitting out in public on the CFTC's website at this link I'm showing you down here. Another study done by Texas A&M AgriLife Research and Extension, 2008, the effects of ethanol on Texas food and feed. This is a study which showed energy prices affects agricultural prices. One of the studies, there's more than one. They say speculative fund activities in futures markets have led to more money in the markets and more volatility. Volatility means the movement up and down and how much it moves up and down of the prices of those markets. Increased price volatility has encouraged wider trading limits. The end result has been the loss of the ability to use futures markets for price risk management due to the inability to finance margin requirements. In other words, the legitimate hedgers can't afford to hedge anymore because the price swings are so wide that the CFTC has to increase its margin requirements on each contract, which prices out legitimate hedgers. Okay, let's explain that in plain English. Margin requirements are when you go to the market and you put in a contract, you have to put up some money in good faith. Not only does the CFTC going to look at you in your overall solvency and how long you've been doing this, okay, but they're also going to say you got to put some skin in the game. That's your margin requirement. When you have higher price swings, that puts more risk in the system. The CME will often up their margin requirements. Well, the price volatility caused by ethanol on Texas food and feed has led to some of these markets swinging so wide, the prices swinging so violently, the margin requirements go so high that some of the legitimate hedgers producing the food and feed couldn't hedge. So they were susceptible to these price swings even more when they went to sell in the market. A lot of them will get bankrupted, or they wouldn't be able to produce the next year, or whatever the case may be. I don't know how else to say it. The research is clear. Let's continue. The underlying force driving changes in the agricultural industry, along with the economy as a whole, is the overall higher energy costs evidenced by $100 per barrel oil. Energy costs affects not only agricultural commodities, but the rest of the market as well. And again, in October 15, 2020 rules, the final CFTC rules are going to enforce position limits. Don't enforce non-spot month position limits on energy commodities. And if you can control the spot month using something you can't be regulated in a future month, you can control that month. But again, it's co-integrated with 1 and 2 year we saw in previous studies. You see how the system works? The system's been rigged to appear to have legitimate controls, but it does not have legitimate controls. And I'm unraveling all this for you guys to understand how this works. And it gets very complex, but that's how they deceive you, is the complexity. And I'm breaking it down for you here in this video. If you don't get everything the first time through, watch it through a second or third time, and it'll start to make sense, I promise you. And you'll understand how ridiculous this game is right now. And again, that was not the spirit of the CEA or the Dodd-Frank Acts. And it's not the spirit of the recommendation the CFTC first made in 2011, 2012, but that's what we have. Another study. This is the last study I think that we're going to have. Food commodity speculation and food price crises by, I'm going to butcher this name, I'm sorry, Olivier de Schutter. He was the United Nations Special Rapporteur, basically like a special researcher or somebody that was providing information to the United Nations. He says in his study, for instance, the price of rice rose 165% between April 2007 and April 2008, a magnitude difficult to explain by reference to market fundamentals. In other words, the supply demand characteristics did not change 165%, but the prices did. And he goes on to quote somebody else's research, Wall. He says, nor, as Wall observes, is it likely that a group of people suddenly developed a taste for consuming vast quantity of dairy products, driving its price up by 157% between 2006 and November 2007, only to lose its price starting July 2008, allowing prices to start falling again. Not only did Olivier de Schutter find this research and his in speculative prices had nothing to do with actual supply and demand. So did Wall, who he quotes in his paper. So multiple researchers are showing in food, supply demand characteristics has nothing to do with these wide price swings up and down. It's speculative activity. It's the only other thing it could be. There's only physical trades, paper trades. If it's not the physical trades, it's the paper trades. All right, another quote. Prices for a number of commodities fluctuated too wildly within such limited timeframes for such price behavior to have been a result of movements in supply and demand. Recommendations made in this report. Olivier de Schutter, in a special report to the United Nations, said we need comprehensive reform of all derivatives trading. We need regulatory bodies, need expertise in commodities markets. And I'm going to show you in a minute where the CFTC staff basically admit they don't have right now this expertise in each commodities market. And he saw this back then, and they admitted it in a staff paper. Access to commodities futures market should be restricted and spot market strengthened and physical grain reserves required. In other words, more physical commodity on the exchange for delivery, reduce speculative positions, reform, and the regulatory body needs to understand more about what it's trying to regulate. That's key. The CFTC does not have all the expertise it needs to regulate these markets effectively. I'm sorry, this would be the last study that we quote. A staff report on commodity swap dealers and index traders with commission recommendations by the CFTC in 2008. And they're going to explain how they don't have the tools to regulate these markets. And that's at least been since 2008 and probably since before that, because this report came out 12 years ago. It says, a quote directly from the CFTC staff report, the survey demonstrates a need for greater transparency in the manner and amount of trading that occurs through swap dealers. Notice how they're focusing on the commercials, the swap dealers, the bullion banks, and gold and silver, but the swap dealers in general. The transparency is healthy both for regulatory monitoring and for market integrity and public reporting. Look at the bolded parts of this. They need greater transparency, which means the CFTC doesn't know what's going on in their own damn market because the complexity of the market as generated by the swap dealers. And they need that transparency for market integrity and public reporting. In other words, how many times have I said that I don't believe the data, the reporting, and the integrity of those reports? They're saying it in their own damn report in 2008, and it's because of swap dealers. Thank you very much for edifying what I've been saying for the last 6 months. I appreciate it, CFTC. I appreciate you putting that in public form, which I can quote on this video. It goes on to say that accurate information also is critical to making appropriate regulatory and policy decisions. In other words, they don't have the information they need to make regulatory and policy decisions completely. They're only marginally effective. That's what it says right there in the damn paper, straight from the CFTC, who is the regulator. All right. The study concluded that the current staffing of the CFTC was not adequate to complete their studies due to the very complex nature of the various markets. They only studied 3 markets out of all the markets they trade on the exchanges. They couldn't study the rest. And even the 3 they studied, they couldn't go in depth. So how do you think they're regulating all those every day? They can't. They also admitted that determining the timing of transaction was difficult. This might be the most ridiculous thing in this report. You're telling me you don't know the time at which those transactions occurred? It's on your exchange. They admitted that determining the timing of transactions is difficult. So the participants can put a trade on there and the CFTC doesn't know exactly when that trade occurred. Well, if you're trying to troubleshoot issues with trades and you're trying to determine who's putting speculative positions and when, if you can't determine timing, you can't determine squat. You can't regulate that market. Ridiculous. Recommendations from the staff for their own recommendations for the CFTC, their own recommendations. Get this, and they're going to focus on swap dealers. What have we been saying about swap dealers and manipulation of prices? Look at what they said in 2008. Removing swap dealers from commercial category due to uniqueness and need to track them separately. Why? Because their market power and the way that they do things and the ability of the CFTC not to be able to understand what the hell they're doing, i.e. how they're manipulating the market. Read between the lines. That's what they're saying. They wanted a new supplemental report specifically on swap dealers. They're going to separate out the swap dealers, put them over here and say, you commercial swap dealers, we're laser eyeball focus on you. That's what we want. Because we can't do it when you're commingled with all these other traders. In bold, more staffing and a new data office. Why? They can't keep up with it. They can't keep up with the market. They need more people in a separate data office just to deal with the data. In other words, so many trades, so much activity, they can't keep up. That's what they said in 2008 in their own damn words, in their own damn report, which is in public at this blue link at the bottom. You can go read it right now. They proposed for the swap dealers removing bona fide hedges, because guess what? Swap dealers don't really deal in a lot of bona fide hedges. They're more speculative position. So they wanted to set a new standard specifically for them. They were admitting swap dealers don't do mostly bona fide hedges, that it's some other thing, and we need to set a new standard in their own damn report. Review swap dealer independence considering they publish research. In other words, is it a conflict of interest when swap dealers are publishing research about a market and then trading the market? What if the research they published were misleading and led to a favorable trade? Is that a conflict of interest? According to the staff, it was. And that hasn't changed, by the way. Okay, end of this part of the video, we're going to go over some solutions, and we basically have two choices. We could go down the current road we're going down, but make some changes, or we could go down a completely different road. The two different choices are provide the CFTC strong enforcement powers, not the crap that came out October 15th of this year, which is total crap, or the recommendations by previous Commissioner Quintans. Ridiculous. Okay, it favors the swap dealers and the commercials. The own staff report I just showed you said don't do that. You have to enforce position limits to remove excess positions of the swap dealers and financial firms, including the financial speculators, because all the financials do basically speculate. They don't take delivery. So it's fair game to regulate them as well, just like the swap dealers. You provide the CFTC additional personnel to monitor and research the data. Give them a data office, give them the people they need. Require strict registration and reporting requirements on positions across all commodities markets. If you're trading on COMEX, I want to know your position on LBMA, period, and a story, and I don't care, period. And across all the different exchanges the CME group monitors. And exceptions to rules require congressional mandate. In other words, the CFTC promulgates the rules. The court can't come in and vacate them. That's legislating from the bench. Screw that. It's got to go back to Congress. You can challenge it in court, and the court will say, you know what? This is what Dodd-Frank and CEA gave them. I can't vacate these rules. It's got to go back to Congress. Now, what are the chances all four of those things are going to happen? Pretty darn slim. So the next choice is to get rid of the national futures market. Get rid of the COMEX, the NYMEX, all the ones. Get rid of the four. Establish local trading markets run by cities and states with very strict rules and speculative positions, not centrally administered, so that you cannot manipulate an entire national market, which in the precious metals determines the price over the entire world through one market. Spread it out, distribute it, federate it, make it impossible to manipulate all at one time. That would reduce a lot of this without having to set complex rules, where you wouldn't have to write 300 pages and 1,700 endnotes. And you wouldn't have to have an effective regulatory body. You would be able to do this simply by disintermediating the financial sector and not allowing one body to go into one market and completely dominate it, either buy off the judges and commissioners or adversely affect them for these opinions that they've been having, whatever the case may be. I kind of favor the second one. It would get back to local markets. A lot of people may not, but I just don't know that we're going to get to the first one. I don't know that we're going to get the CFTC strong enforcement powers. You know, the CEA and the Dodd-Frank, the Congress is legislating it. It's these other swamp creatures, the judges, the financial firms, and the CFTC commissioners are paid. If he wasn't paid off by the commercials, I mean, he must have had some other interest, or he basically was an idiot and didn't understand the role of a regulatory body. Yeah, I don't know. But you got to remove all those conflicts of interest. I don't know if you can do that with the first choice. I think you can do it easier with the second choice. But those are basically the two choices that I see. All right, everyone, that is going to do it for today's report on the CFTC. I think I've given you all the ammo you need to educate yourself on their ability to regulate the markets and how effective they've been over the years and why they've been effective. There's a lot of information there for you. Now, if someone tells you the CFTC is adequately regulating, you can counteract that with the information provided. And if they tell you that speculative positions, which are not, most of them not regulated by position limits, don't affect price volatility, price swings, and the overall price of goods and services, not only in the spot month, but 1 to 2 years out, you can show them there's research that proves that that is not true. And now you know the facts for yourself. Guys, all right, everyone, I want to take a moment to introduce you to the sponsor of this video. It is a company called GLINT. GLINT is a very special company that allows you to store precious metals safely and have access to them anytime. You can simply go to glintpay.com/gold silver pros, as I'm doing here. And on this landing page, you will learn more information about this company. They provide an app that you can download either at the App Store or on Google Play, which will allow you to purchase precious metals and redeem them at any time using their debit MasterCard anywhere MasterCard is accepted. One of the advantages of using GLINT is if you don't want to store your precious metals at home and you're worried about the security of that, they store them at Brinks, which is a world-class depository. It's also insured by Lloyd's of London. So you know that your metals will be safe and you'll have access to them whenever you need to. And using the application on your phone, you can manage your account at any time. Of course, this does benefit me. And so I'd appreciate you guys if you would support me by going to GLINT Pay if you're interested in storing your precious metals at a safe location and having instant access to them with a debit MasterCard. Until next time, guys, this is Robert Keens with goldsilverpros.com.